Buying a car is one of the first things everybody has to learn. What are the advantages of buying a new car? You expect lesser problems with a new car, you get warranty and free service of 3 to 5 years, and you get free roadside assistance to cover the case that your car breaks down on the road. The disadvantages of buying a new car are that they're usually more expensive than a used car. The value of the car drops very quickly in the first few years, 20% drop in the first year, and then 10% to 15% a year for the next 4 years, and you pay higher insurance costs. What about used cars? The advantages of buying used cars are that they're cheaper to buy and cheaper to insure. They depreciate more slowly, and they may still carry a few years of original warranty and free service. What are the disadvantages? If the car is older than 3 to 5 years, there are no warranties or free service left. You need to pay for roadworthiness tests every few years, and there's a greater chance that you may have some problems with the car. As an alternative to used cars, you can also consider buying an approved used car. An approved used car, that's also called a certified pre-owned car, CPO, is a car that's been thoroughly inspected by specialist dealers. They often come with some extra warranties. You don't need to ask a specialist to check an approved used car before buying it. In negotiations, you can ask for summer or winter tires, free service, roadside assistance, and other extras. How does one choose a used car? Choose a car you already know or like, or get a recommendation from a friend. To get an idea of the price, do a web search. How to value a car. In each country, this search will produce a different result. Calculate or estimate how much the car maintenance will cost. That's fuel, insurance, road tax, service costs, etc. Calculate how much you can afford to pay to buy it and how much you can pay every month to maintain it. To buy privately, you need to know a lot about cars or take an expert with you. There are 3 different ways to pay for a car. You can pay cash, which is always the simplest way. Or you can borrow money from a bank or a car dealer. They both offer loans for new or second-hand cars. The lender will want to see your salary and check your credit score. And then there's leasing, which is strictly speaking not a purchase. Leasing means that you're renting a car for a few years and you pay for its price depreciation and some interest and fees. You don't own the car, but you're responsible for all its costs. When you're buying a car for cash, there are some initial taxes and registration costs that you can ask about. You'll need an insurance policy. Typical running costs are fuel, electricity, annual road tax, insurance, and service. So please find out how much each one of these can cost. All the cars need to be tested for roadworthiness every few years. There's a fee payable. When buying a used car from a car dealer, negotiate for extras. When you buy a car with a loan, you borrow money from the bank or a selling garage and top it up with some cash of your own. The buyer pays back some of the principal and interest every month. Interest is sometimes tax deductible. The buyer becomes the owner. The dealers or garages often lend money for car purchases, but they may charge a higher interest rate than the banks would. Always worth checking and comparing. If you don't ask, you don't get. Many people lease cars because they want to drive a new car all the time, or they want to drive a car that is more expensive than they could afford to buy. You receive a car with a higher value and return the same car a few years later with a lower value. So you compensate the seller for the drop in the value of the car. You pay monthly fee plus interest that is usually not tax deductible. You agree to limited mileage, extra insurance, and regular service to keep the car value up. At the end of the lease, you return the car to the dealer or you're offered the chance to buy it. What are the differences between a car loan and car leasing? With a car loan, your monthly payments are higher, but you own the car. With leasing, you're paying the cost of depreciation of the car. It's costly to terminate a lease early. Interest on a car loan is usually tax deductible. With leasing, it's not always tax deductible. With leasing, you can always drive a new car, but you pay more for this luxury and you have to accept some restrictions. In every country in the world, all cars have to be insured, at least for third-party damage. This insurance covers injury to other people and damage to their car or other property by you or someone using your car. A further level of insurance is called comprehensive cover. It usually covers events that are not caused by a collision. These include fire, theft, damage by natural events like floods, hurricanes, and earthquakes, damage by falling trees, impact by animals, or vandalism. With a car loan or car leasing, you are always required to have a comprehensive cover. With each insured item, there may be a deductible amount quoted in your insurance contract. This means that you'd need to pay the cost of repair up to that amount and the insurer pays the rest. Pay attention to these. A higher deductible would lower your insurance cost, which is called the premium, but increase your financial risk. Insurers like to offer 3 to 5 year contracts as this generates greater credit for the salesperson. You can usually request an annual right of termination instead of demanding a 1 or 2 year contract. You'll find a more detailed overview on our website. In the meantime, enjoy the drive.